Hello, Marc Ostwald from ADM Investor Services International, with some thoughts on the meltdown that we've had in financial markets, particularly towards the end of this week, obviously as a result of the global spread of the coronavirus. The most natural place to start is with volatility, with one of the things which has been suppressed for so many years by central bank liquidity and low interest rates. So the first chart of the day is the VIX index. This is a short version of it. I think the significant part is the speed of change here. It is the way that the VIX has now reached 43% at the time this chart was taken, thus spiking above the highest level that we saw during the Q4 meltdown in 2018, which obviously sends a relatively speaking ominous signal. Now, let's move on into the spaces which I have highlighted many a time before as being the points of greatest vulnerability. So the next chart is the investment grade corporate bond spreads. In the greater scheme of things, yes, this is a relatively sharp widening, but we're not even at the highs of last year. But nevertheless, it's the speed of the move that we've seen in terms of spread widening, even if the size of the move from 105 towards the beginning of, just below 105 basis points towards the beginning of the month, and now at 125. It's that which we need to worry about, because that is what signals volatility is on a move higher, and perhaps significantly. It also probably tells us a lot about concentration risk, which I'll repeat again in a few times before I've finished today. Moving on to the next chart, this is the high yield bond spread. As one can see, it's had a certain amount of tumult. This is a slightly longer term chart just to capture what happened at the end of 2018. We aren't quite there yet in terms of reaching those highs, but one has to say that move was actually one which was over a whole quarter. At the moment, the speed of this current move is a good deal quicker in many respects, and that's what we need to worry about. We're at 505 basis points. A lot of it is clearly driven by the energy sector, which is one of the biggest issuers in terms of the US dollar high yield bond market. The next one is a sort of the mirror image of this, and this is the HYG bond ETF. I cite this one specifically because, again, it's about the speed of the down move that we're seeing in it. Thus far, it's not nearly as dramatic as the back end of, or the very tail end of the sell-off that we saw in 2018. However, this particular fund at the end of, or this particular ETF at the end of January had assets worth 20 billion. That was the valuation on it. As of Wednesday, when it saw a 1.5 billion outflow, one of the biggest on record, the assets were just 14 billion. Still a large amount of money, but a huge write-down, relatively speaking, since the end of January, and obviously one where there's a lot of downside momentum. My final chart is one to put everything into perspective. So how bad is this in terms of the longer term perspective? The obvious natural comparison is with the 2008 global financial crisis. We're certainly nowhere near those levels, but we've certainly peaked above all the levels that we've seen on previous spikes over the last 5 years, and that in itself is again a point of particular concern. It also tells us that we could easily calm this down a bit, but we are going to need some much better news if the complacency which has been evident in financial markets and the concentration risk, which is all too evident in the scale of the outflows, is not to come and unsettle financial markets. We are now at that point where we're going to test the depth of liquidity. And those are the thoughts for this week on the current risks to financial markets.